As we approach 2025, the European Union finds itself at a pivotal juncture in its relationship with crypto, and that's because the impending enforcement of the Markets in Crypto Assets Regulations, or MiCA regulations, are a sweeping new framework for digital assets, promising to reshape Europe's crypto landscape, but perhaps not in the way that policymakers envisioned. One of the most controversial outcomes of these regulations is the delisting of Tether, which is the world's leading stablecoin from multiple EU-based exchanges. And while this has been intended to enhance market stability and transparency, this decision may have far-reaching implications for Europe's role in the global crypto ecosystem, especially as the United States, under a crypto-friendly Trump administration, appears poised to embrace digital assets more enthusiastically than ever before. Now, MiCA's overarching goal here is to provide a robust regulatory framework for crypto assets within the EU. And among its many provisions, MiCA is requiring that all stablecoins listed on centralised exchanges be issued by entities with an e-money licence. So issuers must maintain up to 2/3 of their reserves with independent banks and adhere to stringent monitoring and reporting requirements. These measures are basically aimed to curb illicit activities such as money laundering, which stablecoins have been accused of facilitating. And Tether's USDT, however, has not yet obtained an e-money license, making its continued listing on regulated exchanges in the EU non-compliant with MiCA. So as a result, exchanges across the bloc have started delisting that stablecoin, which is a move that has sent shockwaves through the market, given USDT's unparalleled dominance. It's the most widely traded stablecoin in the world, and its removal from this big geographical area like Europe is creating significant challenges for traders and investors who basically rely on its liquidity and its utility. And I think there's a lot of people now within the crypto industry who are fearing that MiCA's restrictive measures may, inadvertently hinder rather than help the EU's burgeoning crypto sector. So let's look at why Tether actually matters and what is the role of stablecoins. Stablecoins like Tether pegged to traditional assets such as the US dollar or euro, and this makes them a vital tool in the crypto ecosystem because they provide traders with a stable medium for transactions. They act as a bridge between volatile cryptocurrencies and fiat currencies like the dollar, the euro, the pound. And stablecoins are also crucial for cross-border payments. I know there's a lot of crypto companies that pay their employees in stable coins, so they just enable faster and cheaper transactions. And so for blockchain-based financial innovations such as tokenized bonds and other digital assets, they're really useful for that. And among stable coins, USDT's dominance is unmatched. It serves as the trading pair for a vast majority of crypto assets. It offers unparalleled liquidity and accessibility. And so removing USDT from the European market means that traders now must either switch to less liquid alternatives, such as Circle's USDC, or rely on fiat currency pairs, both of which are going to increase trading costs and complexity. And much like the UK's position, if the EU doesn't get ahead on this, there is risks of it falling behind, because the EU's decision to delist Tether is coming at a time when the global crypto market is experiencing seismic shifts. If you look at the US, you've got Donald Trump's election victory that sparked optimism among crypto enthusiasts. Bitcoin's recently just soared past $100,000 for the first time, and you've got other speculative tokens and altcoins having these dizzying rallies, and so this newfound exuberance that's stemming from expectations that the Trump administration will adopt a lighter regulatory approach, which might foster innovation and attract investment from outside into the sector. Now, when you compare that to Europe, it really looks like Europe's falling behind. Venture capital investment in European crypto startups is projected to hit a 4-year low in 2025, and this is according to data from PitchBook. By contrast, North America has seen a marked recovery with renewed investor confidence fueling growth, and the EU's stricter regulatory approach, which is, in my opinion, deterring capital inflows and innovation, further widening this gap, and we're just deviating away from each other between these two regions. And the removal of Tether is highlighting this fundamental tension within the EU's regulatory ambitions, because on the one hand you've got MiCA's guardrails aiming to create a safer, more transparent market by targeting illicit activities. For example, there was a report done by TRM Labs, which they say identified Tether as the most used stablecoin for criminal activities in 2024, but that's because it's the most used coin. If you look at fiat currencies, the dollar will most likely be used, the number one currency used by criminals, but it's because it's the most used currency by everybody, and criminals just make up a proportion of the everybody sector. So just because one company is saying that they've identified Tether as being used in these criminal activities like money laundering, terrorism financing, we hear that one a lot. It doesn't mean anything, if anything, it's a measure of the success of that particular currency, if anything. But to address these types of concerns, MiCA have then imposed strict oversight requirements. Tether itself has taken steps to enhance compliance even, such as partnering with this TRM Labs to establish what they're calling a financial crime unit. And on the other hand, these measures risk alienating legitimate traders and investors. It's us that get hurt, because without USDT's liquidity, the European market could become, in time, less attractive. We're going to drive activity to jurisdictions with more accommodating regulations. Now, it's not all doom and gloom. There is a glimmer of hope, because despite these challenges, there are some encouraging signs for the EU's crypto market. According to a recent European Central Bank report, crypto ownership in the European area has more than doubled since 2022, reaching now 9%. However, the European Central Bank has also warned that this figure might be inflated due to changes in survey methodology. So it's described this adoption rate as comparably low, but then they would say that, but you've got additionally Circle, who is Tether's main competitor. They've already obtained the necessary e-money license, so they've kind of positioned themselves to fill this void that's been left by Tether. So if Tether kind of gets banned, which is in the middle of doing, Circle's just kind of ready to take over. So I think there's a bit of strategy going on there for Circle, but it does remain unclear whether Circle's USDC can actually replicate Tether's dominance in this fragmented market. And as the US gears up for a potential crypto boom under Trump's leadership, Europe's decision to delist Tether could have lasting consequences. While Europe's regulatory framework is aiming to create a safer, a more transparent market, it risks stifling innovation, it's risking draining liquidity. So the question remains, can Europe strike a balance between oversight and growth, or is it going to cede its position in the global crypto race? And so the stakes couldn't be higher. With markets evolving rapidly, the decisions made now will shape the future of crypto in Europe and beyond. And for traders, investors, and policymakers alike, the coming months will be critical in determining whether the EU can adapt to this fast-changing dynamics of the digital asset world. As always, guys, thank you for watching. Thank you for listening. Don't forget to like, subscribe, and click on that notifications bell so that you don't miss out on any future updates. And I'll see you all tomorrow. Take care.